Hello, it's Robert Miner with Dynamic Traders Group with their DT Trade Strategies video for the week of September 27th. This is where we do a short video, about 10 minutes, for our Twitter and YouTube subscribers to give you a taste of what we do for our regular DT Reports subscribers. So if you like what you'll learn here, check out our DT Reports at dynamictraders.com. And if you want to learn a complete comprehensive trade strategy from entry to exit, check out my book, High Probability Trading Strategies. I think you'll find it's a fantastic education for the price of a book. So let's get started. We're going to take a look at a couple markets we've talked about recently. What we're going to do today is we're going to talk about trading strategies and multiple unit trading. And we'll use a couple examples right up to date from the time I'm recording this. So let's get started. So this is the SPX and its daily data, the closes. So I'm going to go over a 2-unit trade recently had recommended in our DT Trade Alerts, where we give specific trade recs, and most of our subscribers use that to trade either unleveraged ETFs or some leveraged 2 or 3 times bull and bear ETFs. Some of them even use the same signals for options and futures, but we track it by ETFs, the unleveraged ETFs. So here, and they're relatively short-term trades, meaning short-term meaning typically the trades last anywhere from a few days to sometimes 2 or 3 weeks. Ideally, we catch the weekly trends, but we're going to take a look at why it's really important for every trade that you do, it's a multiple unit trade. And I will tell you this, every single successful trader does multiple unit trading, every one of them. And most unsuccessful traders do not do multiple unit trading. They don't understand trade strategies and how important trade strategies are, because they think trading is about forecasting the future as opposed to just putting the odds in your side and trade management. So here we are, and we've looked at the S&P several times in the last few weeks, and this was the specific trade rec was on the close of this day on September 7th that we had. And we recognize that the market had probably completed at least this little 5-wave advance, that the daily momentums were overbought. They had made a bear reversal the day before, and that was in a position to complete at least a daily high and potentially a weekly high. Now, daily high is usually followed by 3 to 5 days in the opposite direction, so that can be a good trade in itself. But on the smaller time frame daily, if we can position for a potential weekly trend that's 3 to 5 weeks, all the better. But we want to manage the trade with 1 unit. We take profits relatively quickly, and I use daily trends to adjust the stops and all. And then on the second unit, we keep the stop very wide until in the event that the trend gets underway as anticipated. So here we're short here. I had recommended that exit one of the 2 units. We do 2-unit trading typically, and that's what I personally do, is usually 2 units, sometimes 3 unit, but exit half of the position, and it was on a higher close. Recommendation was made the day before this. And why is that? Well, one is we had a nice decline, and we had the daily momentums had reached dual look back oversold and had been oversold for a couple of days. So looking to exit 1 unit on this daily momentum bull reversal, anticipating that more than likely the S&P would have a 3 to 5 day corrective advance. Well, we went lower the next day after exiting, but then it had a couple of days advance on the closes here. Not nearly as much of an advance as anticipated as a correction against this decline. It was fairly minimal, and in fact the daily momentums didn't even reach overbought before they made another bear reversal and came down to the oversold zone several days later. So we then held on to the second half of the position. Once it took out this low, then we would adjust the stop on the second unit to above this high, and using closing data, close above that high. Because if the trend is bearish, it should not close above that closing high. So we ensured at least a small profit, even if we got stopped out of the second unit. Of course, we had these couple really big down days following that. And then the stop was adjusted to a close above this low. And that's based on basic Elliott wave patterns, in that if you have a 1 or A and a 2 or B, if the trend is bearish, the market should not close into the closing range of the 1 or A. If it closes into the closing range of the 1 or A, more than likely it's an A, B, C. So that's a real that's a guideline for any kind of distinguishing between impulse trends and corrections. Is I call them the closing overlaps. Well, we did have a closing overlap. A few days later, exited the trade with a profit again, a little bit more profit than the first half. So now the amateur traders out there are going to go, oh my gosh, you gave back 50 points. Almost 50 points. Well, we're trading for the weekly trend in the second unit, so we have to put the stop where the weekly trend is probably violated, meaning it's probably not going to be a weekly bear trend. And that's a close above there. There's no reason to have it closer to the market. So again, amateur traders, those that do not trade consistently successful, they believe that they can buy or sell the top and buy the bottom. They don't have a trading plan. They don't have a reason for adjusting stops other than to get out of a trade because they got a profit. And then they sometimes, we give back quite a bit, but other times we're in there for the long haul and the substantial move. So we've been stopped out of this market. Both units were profitable. Yeah, we gave back quite a bit of so-called open profit, but the only thing that counts is the price you entered and the price you exited. That's all that counts. And that they're both profitable, that's really good. So let me go over where are we at now as of this day that I'm speaking in the S&P. The weekly momentums, I'm not going to go into a lot of detail. Weekly momentums are still bearish, and the only thing that completely voids a continuation of an impulsive bear trend is a close above 44.8070, this little swing high close. If we close above that, then more than likely this is an ABC. Well, it actually confirms it as an ABC. The close above this closing low is a high probability signal that it's an ABC, but it's only confirmed to close above here. So what we're looking at, here's a specific trade potential coming up in the next few days that we're going to be looking at, is that if the daily momentum makes a bear reversal and the SPX has not closed above 44.8070, that will be a dual time frame momentum setup to consider a short or bear trade strategy. Even though it just got stopped out, if it doesn't have follow through in the upside, we make a bear reversal. We're going to look for a bear strategy. Let's take a quick look at Bitcoin, and also a trade that is recently recommended and why, once again, 2-unit trading is important, and then we'll look at where Bitcoin is right as of the end of this past week. So this is Bitcoin weekly, and of course the weekly momentums are bearish. They're not oversold. More than likely we've got at least another week or two, if not more, sideways to down, and potentially this was not just a multi-week but a multi-month top. Well, that's another story. We've gone into detail with our subscribers with that. If you're interested, check out our DT reports. Here's Bitcoin daily. A lot of stuff on this chart. The most important thing here is going into the early September, we'd probably completed a 5-wave advance. What's that part of? That's another story. Also, the point is we should have had a fairly substantial correction following that, because the weekly momentums were overbought and made a bear reversal. So more than likely we had this first decline. We had a nice ABC correction going in for about 2 weeks, actually about a 3-week time period, and then we've continued down to a new low here in this past week, just pretty much as anticipated. And then again, we've had this 3 to 4 day. Well, we're looking at this as a probable correction, and within a couple of days, more than likely, Bitcoin will roll over and continue lower, potentially much lower. But trading strategies wise, that's all just kind of the technical position of the market. Trading strategies wise, how did we use this information? And by the way, you know, in these little videos for YouTube and Twitter subscribers, each one of these markets I'm talking about now, as I talked about in advance before these trends happened for both of these. So I hope you took advantage of that information. Now I'm trying to teach you some real world trade strategies. Here's the GBTC. It's an ETF that follows Bitcoin, and that's what we use with our specific trade recs. Some people actually trade Bitcoin itself or some other markets, but we use the GBTC as an ETF. So here was the short recommendation, short on the close of this day, which was the 7th, I think, or the 8th. The 8th, and that was because we were in a position to have completed a weekly top, and then we made a close above this little swing low. That was the initial indication that a weekly top was completed, at least a daily, probably a weekly. Market came down 2 or 3 days, popped up a bit. Of course, the stop was above the high. There was no reason to adjust the stop until over a week later, when GBTC closed below this little swing low. At that point, we can adjust the stop to no further than above this swing high, which would put it, if it popped up and took that stop out, it'd be a small loss. So here's how we adjusted a few days later, is because the daily momentums were getting in a position to make a daily low. And because they were in what we call a price momentum bullish divergence, that is, the momentums were at a higher level than they were when the last price low was made. So that's a divergence with you just have a line here and a line there. I think most of you know about price momentum divergences. They're not a specific trade strategy, but they were a warning sign of strength and weakness. So we adjusted the stop on half the position only to the next day that it made a higher close, exit on the higher close. That happened on this day right here, which was the 22nd, the day after this little low. So we had a nice profit here. I think it was about 7-8% decline from where we entered short to where we exited. Only 1/2 of the position. What do we do with the second half of the position? Leave the stop up on this high, above this high, or do something else? Well, what I recommended is that we adjust the stop on the second unit to break even, which was basically at this close, a little bit below the swing low. I think it's 37.40 is where the protective buy stop is now. And we always adjust stops to, at that point, where if the stop is hit, more than likely the trend will not continue in the direction anticipated. So the break-even stop was, pretty close to this swing high, and if the market's bearish, it shouldn't come up and close above this level. And so here's where we're at as of the end of this time, as of the time I'm recording this. Half the position was exited for a pretty nice profit here a few days ago. And then we got the stop at break even at the second half, and that's always the objective, is move that stop to break even when the technical position warrants it. And that technical position can be based on dual time frame momentums. It can be based on pattern, but it has to be based on something. The same information you use to enter a trade, you use that same information to exit the trade and to adjust stops. So we're still short half a position, and actually I'm on alert to add another half a position following the next daily momentum bear reversal. Wherever the price is when that's made, because the pattern is very bearish. The weekly momentum and price position is very bearish, the pattern especially. So we might add back in a half a position following the next bear reversal if, depending on where price is, if we can do it with acceptable capital exposure. If we don't have that opportunity, we're still got half that position short. So that's multiple unit trading, and why it's really important that every trade you take is at least 2 units, and you exit one relatively quickly when you're at a smaller time frame probable reversal, and that what we consider the daily trends, and then we want to hold the second half of that position for the higher time frame trend. In this case, we call it weekly trends. That's it for today. I hope you learned a lot. If you did, check out our DT reports or my book, High Probability Trading Strategies. Thanks for checking out the videos. Be back with you next week. Robert Miner, over and out.